Morning, good afternoon, good evening to you all. Jason Jacoby, Principal Wealth Advisor and Certified Financial Planner at Boyer Financial Services, here with you today for your Friday's closing bell. Big week in the news, so let's get right into it. So September CPI numbers have come out, and while it's the headline inflation numbers are slightly down to 8.2% year over year, which are down slightly from 8.3% in August year over year, due to gas and energy costs being decreased last month. The prices decreased a little bit, which provided a little bit of relief at the pump for us. However, prices are now going to be increasing again because OPEC, who is the world's largest oil producer, is decreasing their daily supply and daily production by over 1 million barrels. And for those of you that don't know, OPEC is located in Saudi Arabia. The U.S. had asked them kindly and somewhat demandingly to basically keep production at a higher level to provide some cost relief. Now, in my opinion, we wouldn't be in this scenario if obviously we were still energy independent. We would have lower gas prices, lower producer prices as well, because gas and oil pretty much run everything in the world, from farm equipment to generators to cars. I mean, need I say any more, right? We rely very heavily on it to heat houses, whatever it may be. We do rely on that type of energy at this point. So again, we do see it going to be increasing here in October. So when we get the October CPI, I do expect the headline inflation level to increase slightly. Again, if the core inflation is still running hot, I do expect the headline CPI to also follow suit and have an increase due to those increased gas and commodities prices as well. So also, speaking of core inflation, which we just briefly mentioned there, it rose 6.6% from a year ago. 6.6%, the highest rate since 1982. Now, this is a little bit more concerning, right? So core CPI strips out the more sticky and volatile food and energy prices. So prices for services. This is a number we wanted to see go down. And we saw it rise to 6.6% from a year ago. Again, the highest rate since 1982. So what does that mean? That just means that the Fed more than likely is going to continue their aggressive rate hiking into 2023. We don't want to get to a terminal point where we raise rates so much. And again, I've spoken to this, Mark's spoken to this, where they over raise rates and over hike rates to the point where it brings the economy to a standstill. We have an extreme global financial crisis mirroring to 2008 and 2009, which again, I don't foresee that happening at this point, but something that we're watching, because it does take at least 3 months to have the Fed policy, to have these rate hikes kind of trickle and get into the economy. So we basically locked in another 75 basis point rate hike here in November, and again in December it could be the same or even more. Again, it just depends on inflation readings moving forward, but we basically locked in another 75 basis point rate hike here this next month, which is unfortunate, but the Fed feels like they have to do that to basically ease inflation, which is one of the tools to do so. Now, with the Fed hiking rates so much and so aggressively, the US dollar is predicted to strengthen as well. It's already very, very strong. We haven't seen the strength in comparison to the euro and the British pound be so even in a few decades. So the US dollar will continue to strengthen as the Fed tightens the money supply and sells off its balance sheet, basically trying to sell the treasuries and mortgage-backed securities that it has in its portfolio. There is a liquidity concern as brought about by Janet Yellen. She has talked about that quite a bit, but and also you've seen it with the Bank of England. They're starting to buy back bonds as well because there was a liquidity issue and they wanted to increase money supply in the market. But again, we're watching all this stuff, not to worry at this point. Still, again, recessions here, in my opinion, it's not it is not avoidable. It is unavoidable. Again, recessions doesn't mean catastrophe, but again, as long as inflation stays around like it is now, the longer the recession could last and the deeper it could be. So, speaking on inflation, we have what's called the producer price index, the PPI, which also measures from the seller's point of view. That was a 0.4% increase month over month, staying at 40-year highs. So again, we want that number to continue to come down because that just means that the producer is going to be passing along that cost more than likely to the consumer. Mortgage rates, 6.92% for a 30-year mortgage right now. That's also at a 20-year high. So obviously, speaking on borrowing, right? So with higher rates, it's harder to borrow. It stifles the growth of a lot of growth-oriented and growth-style companies, like a lot of your tech, your kind of companies that like to borrow instead of raise a lot of cash and have a lot of cash on hand, like your value-style companies, which I heard the other day, which is what the last thing I want to leave you with on this week's closing bell here is the 3 L's of the last decade: low inflation, low interest rates, and low global growth. That favors the growth style equities, the growth style companies, again, that they don't have a lot of cash on hand, that basically keep reinvesting their money into growth and innovation and expansion, right? They tend not to have a lot of cash on their balance sheet and on their cash flow statements. They're just constantly reusing that to again, grow their companies and innovate new products, which isn't a bad thing. But again, when you have rising interest rates and high interest rates, it means that when they need money, they need to raise capital. How do they do that? They need to borrow money. And then borrowing becomes a lot more expensive, which means a lot less profit for them, which means they need to run a leaner business, which you're seeing layoffs already. So with the 3 L's of the last decade, they favored growth style equities. So again, low inflation, low interest rates, low global growth, which we've had the last decade. So you've seen tech explode, which we're seeing a big reversal in that sector, which is much needed in my opinion. This next decade is going to be different. I think the dividend payers, the companies that grow their dividends over time, that have a lot of cash on hands, ironclad balance sheets, your boring companies per se that aren't maybe the most innovative. They can be innovative still, but again, have a lot of cash on hands, give back the dividends to investors. Those I think are going to be the favorable investments over the next decade. And if you look back to the 1940s, growth style companies versus value style companies, dividend growth companies have actually been the best in terms of total return over the long term. And that's something we favor here at Boyer Financial Services. We love those dividend growers, those dividend payers, again, because they can kind of stand the test of time. And again, I'm not saying that there's not a place for growth style companies in a portfolio, but especially right now, cash, because you can get a return for cash now with higher interest rates, treasuries, bonds become an asset class again. And again, the value style companies, the more boring dividend paying companies are going to be great investments moving forward, in which we're currently investing in ourselves. So if you have any questions, feel free to comment below, email me, give me a call. You can find us at boyerfs.com. We're always here for you. If you have any questions, we want to be a springboard for you and answer any complex situations that might occur. So you're going to see this closing bell here kind of morph into more of a weekly podcast. We'll bring on special guests in different industries to talk about life, finances, leadership, whatever it may be. But for now, we want to provide you the most up-to-date economic news and market information. So for Boyer Financial, I'm Jason Jacoby. We'll see you next week.